Continuamos con el Congreso de Economía Austríaca y vamos a hablar de inflación, tanto en esta presentación como en la siguiente. Nos acompaña, como lo hizo también el pasado año, el profesor Leef Dierks, que es profesor de Mercados Internacionales de la Universidad de Lübeck, y nos va a hablar de la normalización de la política monetaria del Banco Central Europeo. Se titula Too Little, Too Late, con lo cual creo que buenas noticias no vamos a tener, pero contamos con tu análisis.
Muy bien. Pues antes que nada, muchas gracias por venir y quisiera empezar con una disculpa porque yo decidí dar esta charla, esta presentación en inglés por una falta técnica del vocabulario técnico, ¿no? Espero que no sea ningún problema, pero para mí me facilita mucho la vida. Bueno, ladies and gentlemen, welcome. Thank you for your attention. In principle, I could keep today's matter very short, saying the ECB made a serious mistake. It is time to admit that and eventually try and countersteer. And eventually it might make sense to look backwards at what went wrong and what could have been done a little better. Only it's very easy, it's very simple for us to look back and say, in hindsight, this could have been done a little better. So instead, why don't you let me explain a little what led to these developments and where I personally believe that things had eventually spiraled out of control. I have two key messages which I would like to support. First one being, I firmly believe that the market has by now priced in 2, if not eventually 3, interest rate hikes over the course of the next 6-7 months perhaps. So if the ECB failed to deliver, it would simply lead to a repricing of risks in the market, volatility would greatly increase again, and we would have the same problem the ECB tried to evade firsthand. Secondly, I also believe that any interest rate hike following now is little more but an admittance of the central bank that the inflation has spiraled out of control. Mind you, as far as I'm concerned, monetary policy is always conducted in a forward-looking manner. The effects will not be felt until 12, eventually 18 months from now. And bygones are bygones. So if we have an inflation rate of 7.9% nowadays, changing the main refinancing rate will not change that. How could it? It will not even have a dampening impact on the June, July, August inflation rate, but eventually for Q1 2023. And that is what I believe the problem we currently have. Now, let us get started, and thank you again for your introduction. What I have shown here, and I could eventually update that every minute now, is the HICP inflation rate for the European Monetary Union, for the Eurozone. Right now we stand at 7.4%, and my firm belief is this number will continue to grow. What it does not fully reflect is the import prices, and what is more, the purchasing price or the purchasing index has totally moved out of control. We are speaking about an increase of as much as 1/3 here. So with the inflation rate up 7, albeit 8%, but with purchasing prices and import prices up 1/3, I believe that there is a certain disbalance which needs to be closed in the month ahead. So there is more to come as far as I am concerned. Secondly, and that is what I would do if I were a central banker, I mean, God beware, but I would argue that after having changed the mandate in June 2021, we are no longer referring to an inflation rate close to but below 2%. That would be my black line saying we need to keep numbers below. The ECB adjusted its mandate saying, on average, in the medium term, we would like to see 2%. At first glance, and for people who perhaps are not economists, this might sound like a marginal difference. Only it's not. Because using these numbers, I could now argue that, on average, since the inception of the euro, some by now 20 years ago, we still are below 2%. So there really is no reason to panic or to raise rates. Only, I believe that time frame is a little too long. If we limited ourselves to 3, eventually to 5 years, we would still say, okay, you have some room to breathe here, but things are not looking good. You need to move urgently. Now, a few moments ago, I said, you know what, this knowing that the inflation rate currently comes in at 7.5%, albeit 8%, don't get me wrong, but frankly, I don't care. It's not going to change anything. I can't change my behavior. I could, of course, argue that in hindsight, it might have been cleverer to pre-move some of my purchases, but what, from my perspective, is significantly more crucial is inflation expectations. The very inflation expectations the ECB argues are firmly anchored across the Eurozone. Well, are they? I have come up with 3 different measures for inflation expectations here, all of them reflecting the medium term. The one on the left is the survey of professional forecasters. So it is a body, you would argue, of economists who deal with inflation on a professional level, which are regularly being asked by the ECB where they believe the inflation will be in 6, 12 months, 24 months, etc. They argue that at the time being, that number comes in at 2.1%. I'd say, fair enough, this is no cause for concern. Unfortunately, that number is not very precise. If you happen to have some banking experience and if you pick up the phone at the wrong point of the day, it might be the ECB asking you for your numbers and to please answer the email. So this much as to an expert. Significantly more reliable is the chart in the middle, my bar in the middle. The 5-year ILS, that is the inflation-linked swap, it is an interest rate applicable for an investment in 5 years for 5 years. So there you get the medium term. This number comes in nominally at 2.4%. So that is where market participants believe that rates will go. Again, I emphasize nominally because if I subtracted inflation, we would still have a real number of a negative 6%, give or take, 5%, give or take. What, however, keeps alarming me is the bar chart to the right. This is the most recent number conducted by Bundesbank in a survey among private households in Germany. It is not where they perceive the inflation rate to be, that is round about 10%. That is where they believe the inflation rate will be over the next 12 months. Now we are speaking about 7%. Well, why is this so crucially important? If you experience inflation rate of 7, of 8%, you will, of course, adjust your behavior. You will perhaps postpone some bigger purchases because you feel you do not have the purchasing power. Alternatively, you are going for cheaper substitutes, etc. Meaning, under these circumstances, the central bank, whose mandate it is to keep price stability, not to stimulate economic growth, we are not in the US of A, but to maintain price stability, is, at least as far as I'm concerned, obliged to deliver. The market has priced in that the ECB will deliver. And if it turns out that that is not the case, we will see an adjustment of consumers' behavior. Again, leading to a spike, leading to a sudden increase in volatility, which, in light of the current developments, is kind of the last thing you would like to see. And if I were to summarize this chart in a few words, I would say, apparently, inflation expectations are no longer firmly anchored. So apparently, this narrative, which has been held upright for quite a while, is no longer as intact as the central bank would like it to be. That is what I have summarized under the term of the decoupling of the inflation expectations. We no longer see these to be firmly anchored. Right. Now, I'm not going to argue that the ECB has not done anything at all, which will not true. Of course, they have reacted. Since March 2016, we have a zero interest rate policy. I need not tell you, we have got a main refinancing rate of 0%. We have got the deposit facility in negative territory. We have got the emergency funding liquidity at 25 pips. So numbers are very, very low. And again, they are in nominal terms. Subtract the inflation and you'll see effectively we have negative rates wherever you look. The ESTER, that is the Euro short-term rate, currently trades at minus 60 basis points. So whenever you argue that banks get money at a rate of 0%, unfortunately that is not correct. They get it considerably cheaper, namely in the interbank market at a negative 60 basis points. However, the point I'm trying to make is, if the ECB had seized the opportunity in 2013, 14, 15, 16 eventually, when GDP growth corresponded to potential growth, we might have ended up having a certain leeway, meaning the measures adopted would not necessarily have been as extreme as they are now. I'll show you what I mean. This is the GDP growth in the Eurozone since 2008. You can beautifully see the spillover effects from the Lehman Brothers crisis, the global financial crisis. Of course, you can see when Corona struck, but you can also see a certain period starting in 2013, lasting until 2016-17, of relative stability. And mind you, don't be disappointed that the growth rate does not come in at 3 or 4%. We are speaking about highly industrialized economies here, where potential growth is around about 2.5%. That is what we have had here. And that is where I would argue, again in hindsight, that the time had come to effectively normalize the monetary policy, which the ECB had by then turned to be super or ultra accommodative. That was, in my view, the time where you could have resorted to a more conservative approach. For the following reason, and that is important for today's conclusion too. You would have then disposed of a completely different set of instruments for the unlikely case of yet another crisis. But the moment, let it be, this pandemic struck, the ECB had simply run out of instruments it could have used to stimulate economic growth again. Now, that said, ladies and gentlemen, and that is what concerns me, some of you will be familiar with the game of chess, and to summarize that in a nutshell, at least that is my understanding, you do not want to be in a position where you react, but you want to act. You want to force your opponent to react to your moves. That's how it should be, I guess. Well, and why would things be so different here? Now, don't get me wrong, this is not a speech on game theory, even though there are certain parallels as far as I'm concerned. But my impression is that by now, it is no longer the ECB calling the shots and markets reacting, but it is the ECB which has come under considerable pressure to deliver what markets have started pricing in long ago. The reason I believe that this is the case is to be found in my second bullet point. I have chosen one of the many pre-indicators we get for what the market is up to. And while the main refinancing rate still stands at 0%, while the ECB still argues that they will stop asset purchases this very month, bringing down numbers from 20 billion to 0, and eventually thinking about the first rate hike in more than a decade, in July, markets have already understood this to happen. My blue line is the 10-year fixed mortgage rate in Germany. My red line is the very same animal for a 20-year maturity. Just look at the dynamics. At the beginning of the year, in January, we stood at round about 1%. Now, we stand at round about 3% for the 20-year fixed-rate mortgage loan. So over the course of just 6 months, mortgage loans have trebled. And that is precisely what I mean. The market has already started pricing in that the official rates will increase anytime soon. This, but that is my causal chain, and please do feel free to contradict. This exerts pressure on the ECB, because if they fail to deliver, we will experience a mismatch between the official rates and what we see reflected in markets. You don't want that. It will inevitably trigger a readjustment process as far as I'm concerned. And my conclusion thus is the ECB remains considerably behind the curve. It's not only too little, it is far too late. Markets have started reacting long ago, and right now this lag is already at 6 months, and with every month going by, we just add to that. So, that said, ladies and gentlemen, I conclude that the ECB currently is not in a position to call the shots on markets. They are behind the curve. They trail market developments as opposed to making markets move to what the central bank suggests. Forward guidance apparently does not function the way it would. The market has already developed its own dynamics. And that said, they simply ran out of adequate instruments. I mean, you tell me, what is it the central bank could now do in case we entered into a new recession? Lower rates? We have the zero lower bound. We have our, 0% already. Conduct more asset purchase programs? Well, again, we have tried it with as much as 3.2 trillion euros. That is 3.2 million euros. And it did not deliver the anticipated effect, unless, of course, you argue that inflation was what they wanted to achieve. So, what precisely would a new asset purchase program bring now? I have difficulties understanding that. Meaning, whatever the ECB is up to now, but let that be my 2 cents here, I believe will not be sufficient to calm inflation and, more importantly, inflation expectations over the course of the next 18 months or so. Reason being, if we have an inflation rate of more than 7%, moving towards 8-9%, do you honestly believe that it will make the difference if my real interest rate then is no longer at a negative 6.4, but at a negative 5.9%? I have my difficulties in understanding that. More importantly, perhaps, is my second bullet point. This decoupling of inflation expectations, as I reckon that inflation expectations have suffered from a permanent upwards shift. It is not temporary. This narrative of Philip Lane, this narrative of Christine Lagarde, over and over repeating that it will be a purely temporary phenomenon, in my view, is simply incorrect. And it was this morning that Janet Yellen, the previous president of the Fed, effectively, I'm not going to say apologized, but at least acknowledged that they had made a mistake, that they underestimated inflation. Ms. Lagarde, now claiming that she was the forerunner when it came to a more restrictive monetary policy, somehow appears little credible, to quote the obvious. I would argue, but again, it is easy to argue that way if you are not directly involved, that we require significantly more decisive countermeasures. Problem being, these countermeasures can only be a more restrictive monetary policy. And the way I understand markets to function, that will greatly increase the probability of a recession, meaning we are somehow stuck between a rock and a hard place. Monetary policy, that is my second point from the introduction, is conducted in a forward-looking manner. The time lag we have is anything from at least 8 to give or take 12 months before the effects are fully felt. That is the average time span we have in our transmission mechanisms. If you today raise rates, effects will not be fully felt until summer 2023. And that makes me believe that if you start normalizing nowadays, it is not because of what has happened over the course of the past few months, but instead, again emphasizing the forward-looking element here, it is because you believe that in 12 months from now, inflation will still be an issue. I mean, help me out. Why else would you want to raise rates if that were not the case? And that, ladies and gentlemen, would basically correspond to inflation expectations having permanently shifted upwards. Now, you will, of course, and correctly so, raise the question what this has to do with Austrian economics up until here. I'm going to make my life very simple, as always, and I'm going to quote Ludwig von Mises, who said, the issue is always the same. It's the government or it's the market, but there is no third solution. Some could now argue and say, well, yes, but government is not a central bank. Technically speaking, I accept and I agree, but in between you and I have my doubts, and I would rather put the central bank into the camp of the government than into the camp of the market. And if you now remember the previous slides, which indicated that the market has already trebled rates, so that the market has already returned to its very own dynamic, I reckon that any intervention which has occurred over the course of the past few crises, so that is ever since 2007, perhaps failed, outright failed to deliver the anticipated results. Call me a neoliberal, but I reckon that markets might have sorted that out on their own in perhaps a little more efficient manner. And those who are now going to claim that any return to a more restrictive monetary policy, to higher interest rates, to less asset purchases will see victims, well, hell, yes, of course it will. But that is not what markets had produced. That is the inevitable outcome of an overly accommodative monetary policy for an unduly long period. Party's over, someone needs to clean up the mess. We shall see corporate insolvencies rising. Of course, all these zombie firms will disappear, have to disappear, I might want to add. We shall see mortgage rates rising. Housing will become less affordable. Yes, it will. But more importantly, what I believe is that should economies enter into a recession, central banks will not hesitate to return to an accommodative monetary policy. And the price we are going to pay for that is a persistent and higher inflation than originally anticipated. I don't want to touch on this topic too deeply, this issue of stagflation, because I believe that right now that still is something we should address, but it's not our base case scenario, to quote the obvious. Simply because unemployment numbers still are very, but very low. But perhaps as a, let's say, an academic food for thought, a purely academic exercise, what if rates increase? What if rates were raised? What if we still suffer from supply chain issues and economic growth fails to recover? I mean, 2022 is the second year in a row where most estimates are wrong again. This widely anticipated economic recovery fails to materialize for the second year in a row. And, excuse my French, I'm sick and tired of hearing that it just got postponed to the year ahead. So now recovery is just around the corner in 2023. Well, what if this does not happen because of higher funding costs? What if we see economic growth remaining modest? It doesn't even need to be a recession. A very modest economic growth will do the trick. Because the moment we will then see unemployment rates increasing, we come very close to this scenario of a stagflation. And I repeat myself, this is not the base case I have, but the question remains, what do you think the ECB would then do? And as far as I'm concerned, it is a rather probable scenario that they will immediately return to a more accommodative approach, trying to weather off any adverse impact at the price of a higher inflation rate, which we will all suffer, which we will all pay them. So, folks, I apologize for not ending on a positive note, but I believe that this is the scenario we currently live in, and as far as I'm concerned, it were naive to argue that things are better than they appear to be, at least from my perspective. Thank you very much, and I do look forward to your questions.
Thank you so much. Tenemos una pregunta aquí en la sala. Sí, tranquilo, está todo, sí.
Hello, thanks for the talk. You said that the markets are already pricing in specific action from central banks. Central banks are behind those expectations at the moment. You also said that then the market will have to react to the disappointment, let's say, at some point. Could you elaborate on what kind of reaction would the market do when they get disappointed? Yeah, thank you.
So, a very good question, I might add, because that is the crucial point. What will markets do? We currently have, depends on the estimates you look at, a scenario of give or take 50 to 75 basis points by year-end 2023. We do have the long-term trajectory that numbers will increase. If I remember correctly, it was Jay Powell who said that the Fed feels comfortable with a scenario of around about 2.5% to 3% nominally, Fed funds rate. I believe the ECB will not go as far. The ECB has a vested interest in artificially weakening the euro as we depend on our exports, and a relatively weaker exchange rate vis-à-vis the dollar will just support economic growth. If, however, the ECB failed to deliver on these two, eventually 3 rate hikes, if the ECB failed to deliver on ending its asset purchases, in my view, it clears the path for an even higher inflation rate, saying we'll sit on our hands, this is nothing we will look at. Portfolio managers will need to readjust. At 7%, 8%, we have reached limits where you will still argue that simply buying shares of stock, equity, etc. will be a perfect hedge. Come 10%, corporates will rethink investments because simply the internal rate of return you will generate might not be enough to surpass inflation, meaning we will very quickly enter into a period of subdued economic growth because both private households and corporates will reduce consumption and investment purposes. Kind of a self-fulfilling prophecy the central bank needs to be aware of, needs to countersteer. Yeah.
Muchas gracias, profesor Dierks. Tenemos también una pregunta aquí, Daniel.
Thanks for your talk. Some will say that the central bank can control only the short-term interest rate, isn't it? And not all short-term interest rate. There is a repo rate that they control only indirectly, and the Fed funds rate or the equivalent in the ECB, that I don't know what the name is, that they control directly, isn't it? So if you see at the yield curve in the US, the yield curve is inverted or almost inverted in the 2 years, 10 years, which you could claim that both ends, 2 and 10 years, are market ends. But it's not inverted if you look at the 3 month, because probably they are controlling. They are also in the Fed. They are also very late raising rates. They are raising very much higher and aggressively than the ECB, but in any case, they are also late. My question is, how I don't really know, how is this, if what I'm saying is right, how is this related with the ECB position? Is it also inverted at 2 years, 10 years? Is it not? And if it's not, why is not?
Well, again, a beautiful question. Thank you very much for that. Now, first of all, if we look into the United States, an inverted yield curve always is a relatively reliable indicator for an economic recession, or at least a period of economic weakness lying ahead. I'd be very careful in concluding that that will happen, but in hindsight, it proved to be relatively reliable. Secondly, if you look at the composition of the United States vis-à-vis the Eurozone, we don't get yet, still to come, I am afraid, I believe, we do not get yet European debt. You have some EU bonds, you have ESM bonds, but you do not yet have the United States of Europe. You have Spain, Italy, Germany, you have Finland, Austria, you name it, right? I could mention 19 names here. But that said, you do have high-quality AAA debt versus weaker debt, meaning when you seek and generate a high rate of return, you can just lower the quality of the papers you have to generate a high yield. And that means that the yield curve, both for AAA paper and for all government bonds issued in the European Monetary Union, still have a well-behaved, that is, normal sloped yield curve. However, no one ever mentioned that an inverted yield curve in the euro area is a reliable indicator of a period of economic weakness. So these are two completely different cups of tea. Secondly, as an answer to your question, I believe, I'll repeat myself, at least to a certain extent, that whereas Jay Powell and the Fed have announced, as you have said, that they will aggressively hike, not more than 50 bips at one meeting, but up until 3% where they feel comfortable, the ECB has never come up with any such statement. By now, you have some investment banks arguing that by year-end we shall see parity returning between the US dollar and the euro, which would correspond to a 12% devaluation over the course of the next 6 months or so. Anyone concerned? Well, as long as you export, thank you very much. How cool is that? But then we need to figure what we import. What we import nowadays is, as always, fossil fuels, mostly, which unfortunately happen to trade in dollars. The inflation rate in dollars for crude oil and gas is significantly lower than the inflation rate in euros for oil and gas. Which means, again, the central bank, the ECB, is in a state of limbo. Raising rates to make the euro appreciate vis-à-vis the dollar would make imports cheaper, would bring down inflation, but would raise funding costs, would lead to a recession. Not doing anything would continue to make exports look cheap, would stimulate economic growth, but would bring inflation to a level where it is no longer sustainable. So, I'll leave it for you to decide where you feel more comfortable, but I believe that inflation ultimately benefits those who have the highest amount of debt outstanding, which by definition is the government then. It's been a long answer, I apologize, but I hope it answers your question.
Andreas?
Yeah. My question is, how do you see the impact of the war on the real economy? And what, and partly you answered, and especially on Germany and the German export engine, and what would provoke on behalf of the ECB these changes in the real economy? Thanks very much.
Thank you. Well, I hate to say, but if you look at numbers, if you do some number crunching, it is supply chain issues in China, which are a significantly larger problem for any export-oriented industry than the war in Ukraine. So that is what drives markets. I could also express it even less elegantly and cynical, you might mean, but the war has largely been priced in already. It is not the risk which currently drives market, unless, of course, things escalate any further. So that said, I struggle to see why the central bank ought to react. By definition, a central bank cannot and will not react to short-term events. if the full impact of a monetary policy change cannot be felt until 12 months from now, any short-term event, such as a crude oil price hike, etc., is not the cup of a central bank. They can't and they won't.
Hi, thank you for your talk. I wanted to ask a question. I want to put a disclaimer because I come from, well, my field is social anthropology. So my question is not going to be very sophisticated and perhaps it's a bit misguided. But you've painted, I think, an accurately gloomy picture of what's ahead of us. And I wanted to ask you to make it gloomier perhaps, or just to factoring something that I find very interesting, and it's how the servicing or the long-term implications of the recovery bonds issued by the European Union after the coronavirus pandemic. How will the servicing of those bonds factor in this inflation ridden future picture, and what implications would that have for the integrity of the European monetary project? It was already quite damaged from the previous Great Recession in 2008. Countries like Spain survived by having their debt bought by the European Union. Now the European Union is the one that has sort of mortgaged the future of the Union. So, yeah, that was my question. Sorry.
Now, I don't understand that to be an unsophisticated question in any manner.
Perhaps I say something like that is not accurate in terms of economic...
No, not at all. See, what is perfectly boring, and I think you'll all agree, is you have a discussion with 100% economists, right? So I much appreciate that type of a question. Thank you for that. There are two sides to what I wish to say. First, from a financial perspective, we need to distinguish the functioning of a market of government debt. Because there's one player we could kick out without changing the narrative, and that's the government, right? So, let's say food for thought. If a government issues debt, among the potential buyers, we have institutional investors. We have international players, PIMCO, BlackRock, you name it. So BlackRock will buy the debt. The debt will mature in 10 years, and up until then, the debt is being serviced. They receive coupon payments, and after 10 years' time, that bond is paid back. The issuing economy, Spain, Italy, Greece, you name it, will, of course, not repay this bond by using taxpayers' money or any such thing, but what they do instead is they will issue a new bond. It's a revolving mechanism. This new bond will again be bought in 10 years from now by some institutional investor. Perhaps not BlackRock this time, but PIMCO. So, in short, as long as BlackRock is confident that once the bond it owns matures, we will have another institutional investor buying the newly issued bond, BlackRock is fine. But the very moment these institutional investors no longer trust each other, you will see markets collapsing. And that is where we will see an intervention, always for the good of the monetary economy. That said, I think that is the second part of my answer. We need to distinguish between the players we have. On the one hand side, we have the economic rationale for a monetary union, lowering transaction costs, facilitating trade, etc. And on the other hand side, we have got the political element. Right now, I believe that we have a political desire to maintain a currency union. I would like to quote the words of the last chief economist of Deutsche Bundesbank, Ottmar Issing, who said, "The euro," and I paraphrase here, "the euro is an experiment. In history, we have never had a functioning currency union without a fiscal union attached. And I believe that either we get that fiscal union for the European Monetary Union anytime soon, or this experiment might blow up. And then, with policymakers such as Emmanuel Macron, such as Olaf Scholz, I believe we move much faster towards the idea of a fiscal union, of issuing joint bonds, as had been the case before." Yeah?
Okay, I have a question. We'll have another question later. Is it possible to follow a Paul Volcker style monetary policy? I mean, a sharp increase in interest rates. Is it feasible? What effects could it have?
Thank you very much. Well, Paul Volcker, being confronted with the relatively high inflation rate in the United States, simply raised rates until that no longer was a problem. The price the United States had to pay were slipping into recession. This is textbook economics. I would say that is your blueprint recipe if you would like to credibly convince markets that inflation is not an issue. But as always, it comes at a price. And right now, I struggle to see the willingness of central bankers paying that price. They don't want to be held responsible for sluggish economic growth, even though that, in my view, but that is a personal opinion, is the price we have to pay. I wouldn't know any other way out.
My question is very related to the last question. Could you do the Volcker rise of interest rate right now? I mean, in the 80s, you have like 25% of GDP, of debt over GDP, of public debt over GDP. Now you have over 100. So maybe if you raise interest rate aggressively enough, you could broke the state. And if you do that, and if you have some kind of backing theory of money in mind, maybe you are gonna cause higher inflation when you broke the state, isn't it? I mean, the central bank basically has in its assets government debt. If you broke the government, this debt is not gonna be paid out. And if you fail, if you default on these bonds, these bonds are actually the backing of the euro or any other modern money. So is even right now is even a way out, raising interest rate if you are going to broke the states?
Good question. So, of course, if you raised rates aggressively now, the refinancing costs of governments would soar too. Have a look at the development of the 10-year German Bund yield. We come from a negative territory of 100 bips to positive territory of 100 bips now. In principle, however, you can argue that we will by then have sufficient institutions in place in the European Monetary Union that could not bail out but buy government debt. We first had the EFSF. The EFSF got transformed into the ESM. And I think that in the long run, we might end up having the European Monetary Fund. We will see special drawing rights, etc. So whenever an economy encounters problems, you could see them stepping in, just like the International Monetary Fund. What if I argued and said, higher funding costs might make states or governments rethink their expenditures? So, to regain competitiveness, but this is our critical debate ever since, would need to return to structural reforms. And then good luck trying to convince some countries that that is the way forward. I struggle to see that. And that is why if you have the joint issuance of government debt, you'll see that some economies will need to pay a higher price, most notably the Northern European players, whereas economies such as Italy, for example, would benefit from, on average, lower rates. To perhaps quote some anecdotal evidence, when I started my career in investment banking, Italy was always perceived to be the better credit compared to Spain. This has considerably changed now. We are speaking a delta of 100 basis points already. So from the market's perspective, Spain is the considerably better credit as of now. And eventually, we might just need to bid farewell to an environment characterized by historically low funding rates. See, I stumbled across, but I'll stop my anecdotal evidence after, I stumbled across old mortgage loans my parents had used. 17%. And I looked at them and said, now, wow, 17%. And that, yeah, good, isn't it? So they were proud, because back then that was a very good rate. Today, when I funded, I paid less than 1%. And I believe that that is not sustainable. But I agree with you, there might be a very rude awakening for some. All right.
Okay,
Well,
thank
folks.
you. Thank you so much.